interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello, everybody, and welcome back to the Raw Selection Private Equity Podcast. Joining us today is David Sopp, an experienced investor turned operator based in the US. Welcome and thank you for sharing your insights today, David.
Hi, Alex. Thanks for having me. It's a pleasure to be on your podcast.
Pleasure's all ours, David. Thank you very much. So, as is customary, if you could give us a 60 to 90 second breakdown of you, please.
Sure. So my name is Dave Sopp. I'm a SVP, Senior Vice President of Business Development with a company called Simply Beautiful Smiles. It's a DSO, or a dental service organization, that's owned by Sun Capital Partners. A DSO is an organization that acquires, operates, offers back office services to primarily general dentistry practices in the Mid-Atlantic area, 40 locations across 5 states. I have a different background in that prior to joining SBS, or Simply Beautiful Smiles, I was an investor, a private capital investor. I'd spent my career investing both private equity and sub-debt. I'd say I'm a generalist, although I've had concentrations in healthcare services and business and information services investing. As I said, prior to moving to the portfolio company side of the fence, I'd worked for an organization that focused on acquiring and managing family-owned and owner-operated businesses across industries. It was an interesting experience in that these are businesses, one, there are lots of them, two, they're businesses that generally need some professional management. So it was an organization that not only acquired these businesses, but then post-transaction effectively became the management team to professionalize these organizations, instituting standard operating procedures, professional workflow processes to allow them to operate more efficiently, more effectively, to maybe capture some of the value creation opportunities that existed from the historical operations of the business, but also to be able to capture a larger share of the market. And I imagine we'll talk more later about my decision to move from the investor seat to the operator seat. Just at a high level, what I'd say is the reason why I chose to do that is because I felt like it gave me more of an opportunity to have more of the ownership of the execution of the best practices and the strategy that's developed by private equity sponsors, by the board of directors. It kind of felt like, hey, I'm involved in developing these themes and these operating initiatives, but I'm relying upon somebody else to execute those strategies. I was interested and I've enjoyed having the opportunity to not only develop those, but also to be able to execute them as a member of a portfolio company.
Yeah, interesting. Well, let's dive into that concept. So you mentioned obviously that transition from investor to operator, which I would have previously said was quite rare, but because of the amount of people we've had on the podcast, it's actually fairly common in my eyes. But I know that it's certainly not in the perspective of the wider private equity network. So what delving into deeper there, what made you make that change? What was kind of making you think I need to scratch this itch?
Sure. So I would say one of the things that's interesting about private equity is that you become an expert. I wouldn't say you become an expert. You become knowledgeable in a wide range of topics. It's kind of this mile wide, inch deep, as opposed to a mile deep and an inch wide. So I kind of felt like, as you said before, I had some concentrations in some niche healthcare services and in business and information services. And I had a desire to maybe start to concentrate a little bit more and to become more knowledgeable about specific industries. So I wouldn't say I had a passion for dentistry. I mean, it's kind of ironic that I ended up in the space and that I'm actually a big baby when it comes to those types of services. going to the dentist was not viewed by me as being an experience that I was looking forward to. So, but what I did come to learn is that it's a massive market. In the U.S., you've got close to a couple 100,000 dentists, close to a couple 100,000 practices. It's an industry that's highly fragmented. It may be consolidated 10 to 20%. There may be a couple hundred private equity-owned platforms of these DSO organizations. So to me, it seemed like there was an opportunity to target a large market that was still highly fragmented and still offered a lot of consolidation potential. And quite frankly, I mean, it's just a service that's not going away. People are always going to have emergencies. They're always going to have their teeth cleaned. They're going to need to have cavities fixed. I wouldn't say it's a recession proof industry, but I would say it's recession resistant. And when you think about technology, is that a threat that that's going to negate or maybe obviate the need for the services? I think technology is more of an enabler in terms of how you use it to diagnose, to treatment plan, but you're still going to need to go to the dentist at some point to have services delivered. So to me, it was an enduring industry, an attractive large market that was highly fragmented. And that was the reason why I decided, hey, this looks like an interesting vertical. And then it was about finding the right platform that offered growth potential.
So having seen that both sides of the table now in that operator seat, what either have you learned from making that switch and going from there, or what do you wish that you knew back then when you're an investor, now that you're an operator, of I wish I didn't do that, or I wish I'd done this previously?
Yeah, it's a great question. I'd say I came into the role with just a much better understanding of what I was getting myself into. I think for folks that haven't worked either for a private equity owned business or as a private equity investor, I don't think they really understand the intensity and the maybe the focus or the effort level that's required to work for a private equity owned business. As you know, private equity investors are smart folks. They're demanding, they're successful. They're going to look for people that maybe have similar characteristics and have similar ambitions as to what they can accomplish. You've also got investors that have a relatively compressed time frame. They're investing out of a 10-year fund. They're going to have hold periods that maybe range from 3 to 5 or 6 years. And these businesses, which are generally buy and build strategies, you need to do a lot of transactions in a relatively short period of time in order to build the business to create a return for the equity investors. So I'd say one was I came to the business with a good understanding about who's my partner going to be, who am I going to be answering to, what sort of questions are they going to ask, and what sort of answers are they going to expect. So that definitely put me in good stead to be able to go in with my eyes open. I would say one of the things I took from private equity that allowed me to be successful in the role at the portfolio company is having disciplined, scalable, repeatable processes and templates for how do you originate, how do you evaluate, how do you execute transactions. While the pace in private equity is lower, we maybe did, 2 or 3 platform investments per year and half a dozen add-on investments, whereas at a portfolio company, we may be doing 15 to 25 smaller deals per year. It requires that you have, again, good systems and processes in place to be able to do things in a disciplined manner at the pace that you need to do them at. So I was able to kind of take some of the best practices and tools from private equity investing to apply them at the portfolio company to figure out how do I find targets once I get a target or develop a relationship with the company. What sort of information do I ask for? How do I index it? How do I evaluate it, analyze it? How do I package that information, share it to get approval for the transaction? So I think one of the things that I really took from my private equity experience that's allowed me to be successful on the portfolio company side is really just kind of a standardized process and systems to be able to execute at a faster pace, but be able to maintain the disciplines that's required in private equity.
Interesting. So what's, again, both sides of the table insight here. So what's one mistake that you see the private equity firms or portfolio companies making, and what actions would you suggest to correct them?
I guess at first I'd say, look, as we all know, private equity is a high performing asset class, and managers are doing plenty of things right. So for me to kind of sit in the bleachers or the cheap seats and make comments about things that people are doing wrong, it needs to be taken with a grain of salt to say, look, they're doing a lot of things right. From my perspective, what would I change? I'd say the primary thing is reducing margin of safety going in by paying too high of a price. And what this causes is it results in a business that many times has too much leverage, and it requires flawless execution. It just doesn't give you the degrees of freedom in order to respond to the inevitable challenges like changes in macroeconomic conditions, changes in market conditions, the ability to attract and retain staff. So I guess what I'd say is it's a wonderfully performing asset class, but I think one way that could improve the performance is to be able to acquire businesses at more attractive multiples. Now, how is that done? We can talk about that later, but that would be the one thing I'd say that could result in better performance for the asset class going forward.
Sorry to interrupt here. Just a quick note to highlight our new sponsor, Grata. The private equity market is rapidly shifting to a data-driven, proprietary deal sourcing standard. Grata provides the window into over 7 million middle market private companies. Contact Grata so you can access the market first. Request a demo at www.grata.com. Now back to the podcast. Okay, well, instead of talking about it later, let's talk about it now. How do you acquire businesses at more attractive multiples? Because I'm sure everybody would be keen to get this one.
Sure. And I would say you're already seeing some of these corrective actions. Sourcing off market and proprietary transactions. The cold calling model is not unique. There are lots of organizations that do it, but I think firms are being more thoughtful about how do we identify transactions, whether it be with entrepreneurs that we've backed before, or developing our own investment themes and strategies to be able to identify transactions or investment ideas that maybe others aren't pursuing yet. So the ability to develop your own proprietary deal flow, which is not easy, but not sitting back and relying upon the investment banker books to come in is one way to develop, to find opportunities that potentially are available at more attractive prices. Again, this is kind of a mature theme within private equity, but utilizing operating resources to create and realize upside. So, taking a business and being able to maybe look at it in a slightly different perspective and say, hey, there's more to this business here than meets the eye. And I can talk to you about that more later and give you a more specific example, if you'd like, about our investment at Transformative Healthcare. But basically saying, look, this is a business that works on its own, but there are other elements to it that we could potentially expand in order to differentiate this business, make it more diversified, and to be able to to grow and to create equity value. Basically, what I would say is that just a general change in the mindset and creating equity value from not from financial engineering, but to building businesses with world-class talent in operating procedures, in systems, effectively building a business, knowing when you get into a transaction, who are the likely buyers for this business and what are they looking for, and effectively building that asset for them. I think those are some ways to be able to mitigate the price that you pay going in, and potentially to create some value that isn't there in the business when you acquire it.
It's interesting, really valuable, certainly valuable stuff. So you've come from, obviously, as we mentioned, that kind of investor role. You're now working under what is a pretty large private equity firm. The lower middle market's always keen to learn from the big firms, the Carlyles, the Warburgs, some capital partners, equally not as big as Carlyle Warburg, but still very much a very big animal doing large cap deals. What have you learned from working with such a big firm that you think the lower middle market would benefit from?
Yeah, it's, again, great question. And I've been very impressed by the folks at Sun. And part of me says, hey, I really see how they're able to do investing well. And part of me also says, well, they can do it because they have a lot of resources. So, the recommendations that I make for a middle to lower middle market investor, it just may be hard to do with the resources and the constraints that you're dealing with. But I'm, maybe as you picked up earlier in the conversation, and as we go on, I'm very much a process-oriented individual. I like to have, again, tools and systems and processes that I can follow to be able to make sure that I'm looking at one investment opportunity similarly to another, and that I can compare one deal versus another. To me, I look at some of the ways that Sun evaluates larger investments, because they're really getting involved with us when we're looking at larger add-on acquisitions. It's not for an acquisition of 1 or 2, 3 offices, but it's for an acquisition of a company that maybe has a dozen plus offices, and you're probably looking at $50+ million of enterprise value for the transaction. And they just have a very organized, structured way of what is the information that we're looking for to really understand this business, and to compare it to what we have, and to really look at, what is it that's causing this target to be successful? Are there any sort of potential risks there? Are you concentrating with certain providers, certain payers? And then utilizing external parties, call it, for example, a CPA firm, in order to kind of peel the onion. So, there are lots of definitions of cash flow and what gets added back. And there's a lot of complexity there to really understand, hey, when I buy this business, how much cash is it going to generate in the first 12 months that I own it? Because ultimately, that's really what you need to be valuing the business on. And there's a lot of noise in historical numbers and COVID adjustments. And hey, we opened new offices here, and we lost this provider, and we added this payer. So being able to use a CPA for a quality of earnings analysis, and that's not rocket science. That's used across the private equity industry. But being able to kind of scope the project, to be able to move quickly, but to get the answers that you need to really drive to how much cash are we going to generate from this business. And I think it's about scoping that QB project to not just say, hey, are the historical numbers reliable, which is part of the analysis, but really more about when we own it and we layer it with our cost structure, how much cash is it going to generate? So I've just been impressed by Sun's kind of rigorous approach, their ability to be very methodical and detail oriented in the analyses that they're asking us to complete, and being able to, I guess, get a wide range of perspectives from their investment committee to be able to respond quickly. So those are some of the takeaways that I've had from Sun, and it's kind of made me realize, boy, there's a reason why these guys have been successful historically. And those are some of the reasons, or maybe some of the patterns that I've noticed that they do well.
Okay, so and interesting. So with regards to the top performer level, you've seen things at private equity and investor level and portfolios we mentioned. What 3 attributes do you believe make a top performer?
I guess it's hard maybe just to distill it down to 3, but to answer your question directly, I'd say 1, intellectual curiosity. You have to have a desire to continue to learn. and to continue to improve. As we know, the world continues to change, and to be successful, you need to be able to keep pace with that. You have to understand, you have to want to know about what's changing. How does it impact my investment? What sort of what sort of challenges does it create? What sort of opportunities might it create? And to be able to then read those developments, to be able to develop strategies, to be able to either protect or to grow your investments. So I think you have to be passionate about learning about new industries, meeting new people, developing new skills. So I guess I'd say it's intellectual curiosity. Second, I'd say it's probably the ability to have pattern recognition skills. So what I mean by that is, while you may be looking at investments in different industries, there are similar characteristics that you'll see across industries. And to be able to look at those patterns and to recognize them helps you become more able to get up to speed on new industries and new business models faster. And really trying to identify, scope out a diligence process, to be able to lead a diligence process that identifies potential risks, and allows you to, maybe to run sensitivities about how likely is this to happen, if it's likely to happen, what are the ranges of outcomes, to be able to structure a transaction to be able to mitigate that risk, and then potentially just to identify showstoppers or deals, risks that you just can't get comfortable with and you can't structure around. So I think the ability to recognize patterns, it allows you to get up to speed on new industries quicker, but it also allows you to learn from prior investments, to say, oh, there are some similar dynamics here in terms of the payers, there are some similar dynamics here in terms of the employees, that allow you to say, well, how we had challenges here with this investment, we need to figure out if it's going to present similar issues here in this new potential investment. And the last thing I'd say is really confidence. We're talking about taking calculated risks to assess a range of possible outcomes, and really to have the courage of conviction to articulate, support, and pursue your investment theses. You've spoken to a lot of private equity investors, Alex. They're not shrinking violets, and you're going to be challenged as to why your investment thesis makes sense. And if you don't have the belief, the confidence to be able to support that investment, you're not going to get deals done. So I think it's confidence to be able to see an opportunity and to be able to articulate and defend your investment thesis.
Well, so just talking about that, dealing with investors and dealing with the shrinking violets that are private equity professionals. What advice would you give now as an executive in a portfolio company to operators, C-suite executives in other portfolio companies to better engage and better communicate, up the chain, if you wish, to private equity professionals?
Yeah, it's an interesting conversation. I mean, I think the first thing is you need to be aligned. You need to have the same vision in terms of what is it that we're trying to get accomplished here. I mentioned earlier trying to identify maybe who are the likely buyers for this business and what are we building for them in order to create value. I don't know how often it happens, but it wouldn't surprise me if it does happen, that you've got a executive leadership team that isn't necessarily on the same page with the sponsor. So I think in order to be successful and all be working together and pulling on the same oar, you need to have similar visions in as to what the mission of this business is and how you're kind of what the end goal is and how you're going to get there. So to me, I think that's a big part of the success factors. Now, private equity investors, as you know, are looking to back the A management team. You know better than I do, but it seems like a reasonably high percentage of management teams get changed after a transaction. Either that's because you've got a founder-led team that's taken a business to really as far as they can take it, and each day they wake up, they're managing the largest business they've ever managed, and you need a different set of experiences and characteristics in order to take that business to the next level. And many times those are entrepreneurs that a private equity investor has worked with before. Because not only do you need to be on the same page, but quite frankly, you need to go through the battles. You really don't understand each other until the train gets off the tracks. It's when problems and challenges present themselves that you really understand, is this a true partner here? Do I have support from this partner? How do they respond in those situations? Are they constructive? Are they helping me solve these issues? So I guess what I've seen, and I think what makes for a successful partnership is one, being aligned on what's the strategy, how do we get there, and two, maybe having experiences where you've been through the battles before and you kind of know how your partner is going to react. I think that's really where you get to know each other the best.
Makes sense. So what are your influences, David? What do you read? What do you watch? What do you listen to that you recommend others should check out?
Sure. Maybe nothing proprietary here. I read the Fortune term sheet daily email, keeps me abreast of trends in the industry, deals are getting closed, people movements. For me, in the dental space, similar daily email called Becker's Dental Review, which is kind of just staying up on the trends in the industry, transitions, transaction closings, competitors. From a more general standpoint, I like to listen to the David Rubenstein show. I just find it interesting to learn about how about people's backgrounds, what their leadership styles are, and the various paths that people have taken to success. I'm always surprised by it's not a straight line. It's not like, hey, I want to get there and this is how I'm going to get there. A lot of times it's, I didn't even know this industry existed. I was going down one path and it was kind of serendipitous that I shifted to another path, and it led me to a passion that I didn't know I had and allowed me to be successful. So kind of just hearing stories about how people have achieved success in their careers. And for me, it just kind of keeps I find it interesting, and it also maybe just makes me keep my ears and eyes open to saying, maybe there's an opportunity for me to go down a different path, and I don't know what that is right now, but it kind of lets me to turn up my radar screen a little bit, or tune up my radar to just always looking for opportunities.
Pretty good advice. And should anybody wish to reach out to you post this podcast, David, how best do they get in touch, please?
Sure, I appreciate that. Probably the best way is to find me on LinkedIn. And to send me a connection, and we can start to develop a relationship from there. I'm open to sharing my experiences in more detail than what we've chatted about today, Alex. And my hope is that it's a two-way street. So I'm happy to share my experiences and develop relationships, and I'm looking to hear stories of other people and figure out how we might be able to help each other.
Well, David, thank you very much for joining us. Thanks for giving us all the insight and the different perspectives of private equity, investor world, right through to the operator to world. And thank you very much for everything you shared.
It's my pleasure, Alex. Thanks for the content that you produce on the Private Equity channel, the Private Equity Hub, and I'm looking forward to continuing to view your podcast. And I should have mentioned that as an influence, actually. I was remiss not to mention that. You gave me stats earlier in terms of the number of folks that are downloading this, and how often, what the cadence is of you producing it. And seems like you're able to get good guests and a lot of interesting content. And I appreciate you taking the leadership on that.
Absolutely my pleasure. Happy to unlock the Pandora's box that is recruitment, that is the private equity industry at times, and the not as transparent and open as possible. But we've done very well. We're now in the top 5% of podcasts on a global basis based on downloads, so I'm told anyway. It's going really well. So, and thank you very much for those joining us and listening in today. Should you ever need support with private equity professionals, portfolio executive hiring, or if you're looking for an opportunity yourself, please do reach out to us at Real Selection. We'd be delighted to support any processes needed there. And if you have not already, please do subscribe and join one of the top 5% podcasts globally, and you'll be notified of the next podcast, which comes out every 2 weeks. But till the next time, keep smashing it, and thank you very much for listening.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.